Hey everybody, welcome to this video. This is Shane Smillian from Wolf Trade Futures, and this is your introduction to the Bradley Part 6. This is the sixth part of our series here. And in the first part of our series, we focused on the Bradley Barometer in the past before the Fed became a thing, but now we're going to focus on the Fed and how did the Fed affect the Bradley Barometer? How did it affect the forecast on this thing? And so we're going to start to see that as the Fed got stronger and stronger, particularly during periods of quantitative easing, that the Bradley really just is a meaningless indicator. The market's going to follow what the Fed does. And you can see here that this is the financial crisis into here, and I have this as QE1. They started out with QE0 into here where they were experimenting, and then the real QE starts into here into March. And you can see these are when these operations really start to kick into gear into here. And originally the markets into here. Originally, QE was not meant to be a long-term thing. They were going to try to sell off the bonds back to the market, and they tried to do this right into here, and they tried to sell these off, and the markets immediately started to sell off. And so Bernanke came in at this point. He's like, "No, I'm just kidding. We're not going to sell these off," and the market took off again. And then the Fed was able to continue to ramp up the Fed internals and more bond purchases, do whatever was necessary here to keep this market going forward here. So it became a very, very interesting phenomenon into here. And you can see that even as the Fed internals started to wane a little bit into here, the market would even start to kind of level out into here. And we'll get, this is not a video specifically about the Fed internals, but this is really when the machine took over the markets, so to speak. And so the unnatural forces became dominant. So this is the unnatural forces of the Fed. This is really when it became dominant in the market. But how did it affect the Bradley? So what I want to do now is I'm going to go through each operation of the Fed with quantitative easing, and we're going to look at what did the Bradley say, and then what was the Fed saying about them? What was the Fed doing behind the scenes in the market? This is it's an interesting story into here. And again, this is like the very beginning here, the QE0, when they started messing around with this, and then they really figured out how to do this. So why do we care about this? Well, we want to be able to understand and forecast what's going on in the markets, and to do that, we have to take into account what's going on with the Fed and also the Bradley. So the Bradley, I'm using this as an example. There's many other ways we can look at astro numbers in the markets, but this is the one we have been looking at here. And I've showed you all those examples of the past and all the past market crashes and how the Bradley did. But now we're going to look at the Bradley here in the context of what's going on with the Fed. So first off here, you can see I have these little, I have like a checkbox, and I have an X and a checkbox and an X and an X. What that means is I'm basically gauging when did the Bradley work, when did the Bradley not work. And so you can see here the Bradley does pick this big rally up into here. We talked about this before, that it actually bottomed. This is the 2009 graph here. It bottomed a little bit earlier. The market did another bottom into here. Again, some of the markets, some of the stronger tech stocks actually bottomed here and had a higher low, but this is when the rally begins. And then you can see this is a check mark here for the market. But this is, so the theory here is that when the Fed is strong, you have an upward bias in the market. So of course, when the Bradley is going long here, when the Fed is doing quantitative easing, we are going to see the market respond to the upside. I'm going to show you every example of this as we go through the year, so you can kind of understand what I'm saying. Because it's one thing just to say that, but it's a completely different thing to demonstrate this and show you guys this piece by piece. Then I have an X here, and you can see the Bradley Barometer has this big drop into here. A lot of people felt that with this, like I said, this was like a little head and shoulders into here. People thought that the market was going to keep going down. A lot of people thought that this was going to be a turn lower in the market, but they didn't understand. What they didn't understand was that the Fed was behind the scenes. And the Bradley, which had worked so well before, all of a sudden stops working. The market completely ignores this and just keeps going up here. You can see this. The market, it's almost like the Bradley didn't exist here, because this is not natural market motion. This is the motion primarily from the Fed intervening into these markets. So once we get into a situation where the Bradley's rising here, then we would say that's a positive thing because the Fed is strong, and so we want this to keep rising into the markets. The markets keep going up just a little bit past the Bradley was falling, So it didn't really work here on this turn either. And if we go back, and again, I'm kind of going back and forth between these two charts here, but if we go back and forth again and I show you, you can see these spikes here by the Fed. So what you can't see with the Bradley, you can see very clearly here with the Fed. The Fed stops this decline here. Okay, they come into here. You can see, you can start to see these little humps in the market kind of follow what the Fed is doing. Market was flattening out here. Fed comes in here. You can see this little hump comes up into here, and then the Fed pulls back, and you can see this is when the market starts to sell off. So now we're in this phase where the market really it follows what the Fed does. So the market was already underlying weak, and so really we're going to track what the Fed internals are doing, and then we're going to try to put that together with a Bradley. When we get, so the theory is here is that Fed strong, like I said, unnatural forces, so unnatural. So what we want to do here is we want to align with positive natural forces. Natural forces. Natural. So we wanted to align this with the positive natural forces. So what does that mean? That means that every time that the markets, that the Bradley gets positive, and we're in a phase where the Fed is strong, we want to try to look for those long side entries. So the next slide I'm going to show you here is a phase. This is in 2010, and this is when QE1 ends. Okay, and so what we see is immediately the market starts to fall apart. Now, I've shown this to a lot of people, but not really in the context of the Bradley. So you can see here that here's the Fed internals, this little hump up here, and you can see here we get this falling down. Market tries to do one more rally into here, and then the QE1 ends into here, and so everything starts to drop. You can see the Fed internals start to tank into here too. Once QE1 ends, you can see the Fed internals tank, and so any rally here cannot be sustained, and you see these just choppy action into here. Just a really rough time that the market had with this, and then all of a sudden we start quantitative easing again, and then here we go again to the upside. It's almost like Dr. Jekyll and Hyde, two personalities, split personalities, twin personalities. One does not resemble the other. Okay, so we've entered this phase now of the unnatural market forces dominating. And we can compare that, like I said, to the Bradley, but you can see here, here's the initial burst here with QE2, and then we had this really strong surge into here, and the market really just took off almost in a linear fashion here, completely ignoring any cycles, any negative astro, anything negative into there. It didn't matter. But the minute you get into here, you see things fall apart. So this is kind of like steroids into here, and this is kind of like natural into here, right? So the minute someone gets off of the steroids, they fall apart. They get back on the steroids, they get strong again. So this is impressive just in of itself, just by looking at what the Fed is doing. But again, the context of this needs to be, what is the Bradley doing? So how do we time this with the Bradley to get good entry points or favorable entry points for the Bradley? So the first thing I want to talk about here is that, well, let me erase this here. So we started to get a situation here where, remember, the sell-offs in the Bradley wasn't really working, and so we started to get this. It was doing this last little rally phase into here. It was doing its last little rally phase into here, and you can see then the Fed shuts off quantitative easing, and all of the sudden the Bradley starts to work again. You see this, how it's working to the downside? All of the sudden the Bradley becomes very, very accurate in terms of forecasting what the market's going to do to the downside. So I put a little checkbox there because that means that, hey, look, it's working again. Why is the Bradley all of a sudden working again? We went back into here, right? We went back into here and it didn't work, right? We saw these situations where the Bradley was going down and the market just kept going up. Why all of a sudden now, when we get into here, is the declining Bradley working again? Well, it's pretty simple. The Fed stopped quantitative easing into here, right? The Fed stopped what they were doing, and so we returned to the natural forces. So this is really now the reality that we live in. We need to look for these little slivers where the Fed is strong or the Fed is weak. And when the Fed is weak, then we can look at the Bradley for the negative astro, and we can say, hey, you know, this can go, the market can go down now because the Fed is weak. When the Fed is strong, it's really, really hard for the market to go down. You can see here that once the Bradley bottoms into here, You can see this bottom into here, and then the Fed starts the new round of quantitative easing into here, and you can see the Bradley. Now, this is what's interesting about the Bradley here. So the Bradley comes into here. So the Bradley's predicting a positive rise into here, right? And so this portion right here, this is correct, right? So going forward, this is correct. The more it did pick up this rally, and so that's great. But you may have wondered into here, people are looking at the Bradley and they're like, hey, the Bradley says that's a top right there, right? The Bradley says the market shouldn't go any higher right here. The market should just start going flat or sideways into here, right? Why did the market keep going up like this? Because quantitative easing is going on, because the Fed is very strong into here. So again, the downward phase here works because the Fed is weak. The downward phase here fails because the Fed is strong. Okay, so that's the takeaway from this. So now it's important to overlay what the Fed is doing. So again, looking back at the Fed here, you can see very clearly from what's going on with the Fed that there's money pouring into this market. Liquidity is surging, right? And you can see that even though the Bradley says, hey, this should be a top, it doesn't matter. It just ignores the Bradley and keeps going up because that's what the Fed wanted. That's what the Fed was doing. And so again, this is a whole new world, and it took me until about 2011 to figure out what was going on. Keep in mind, this was just a year after the crash. I think a lot of people did really well trading the crash down. Forecasting was good. Retracement levels were good. Astro signals were working. Cycles were working. All this stuff was working. And then all of a sudden, it's like split personalities. Like sometimes it works, sometimes it doesn't. What is going on? And it really frustrated a lot of people. A lot of trading systems that had worked stopped working. A lot of forecasting models that worked completely stopped working or became schizophrenic, like in the sense that like it would work here, but then it wouldn't work here. And people were like, hey, what the heck is going on here? For a lot of people, this was too much to wrap their minds around. Like they just couldn't admit to themselves that this is what was happening. But indeed, this is what was happening with the markets. I mean, it's clear as day when you take a look at this. You can see the inflation, the deflation, the inflation, and then you overlay that on top of the Bradley, and then you start to say, oh, okay, this makes total sense. There's no Fed into here. The market can fall. Okay, the Fed is getting strong again into here. It doesn't matter if this is topping. It's just going to keep going up. So that's really the first introduction here. So we're starting to, so for the first year and a half here, this was really, really, I would say year and a half, 2 years. This was very, very confusing to a lot of people. But then after about 2 years, like I said, I think people started to figure it out, and then I really started to figure this out. And I'll get into the later years, 2011 to 2012 next. That's really when I made the pivot to understanding that we need to pay attention to what the Fed is doing, and then kind of dovetail that with the Astro to get a better forecast. All right, guys, that's it for this video. Thanks so much for watching. I really appreciate it. Make sure to check out part 7 in the series where we're going to look at 2011, 2012. And until the next time, I hope everyone has a great evening. Stay safe out there, and I will talk to you soon. Peace out.